Hello everyone. Today I'm going to talk about how to value Oracle stock and whether now is a good time to buy or sell Oracle stock. I started to invest in Oracle in 2020, and in the past years I have been keep valuing and updating my valuation. If you see the picture about 1 year ago, I posted my estimated value and price for Oracle. If you have been watching my previous video or reading my previous analysis, you know that I always stress about the difference between value and price. Value means how much an asset worth, while the price is driven by the mood and momentum. Just think about the concert or football ticket you bought. When you bought a ticket from the official website, the price is set by the company, and that is based on the company's cost, investment, and how much money they want to make. However, if you want to buy a second-hand ticket, a 100 or 200 ticket can be as high as over $1,000. In contrast, if there's going to be a rain on the day of the concert, then a 1,000 second-hand ticket can decrease to lower than 100 or $200. So that's the difference between value and the price. And about a year ago, I estimate that the Oracle value is about 60 to $80, while the price for the Oracle in the future is around 127, 184, 227, and 350. You may wonder why there are so many different prices. And in the rest of video, I will explain that. And about 7 months ago, I updated the price to buy Oracle at 105. And you can see this is the Oracle stock movement in this year. This is the agenda for this analysis. First, I will talk about the Oracle business model and business segment, what Oracle is doing, what product and services it is offering. And then I will estimate the growth in the future. Companies like Oracle, they sometimes will acquire other companies, and many companies they acquire are private companies, which means they do not have public financial information like how much revenue or profit they make each year. So how to estimate those private companies when you have limited or few information? And I will talk about that. And after that, I will talk about how much I think at this moment is a good price to buy and sell Oracle stock. Another thing is in the market, you have been hearing so many news from investment bank, from those institutions. And I have an example about how JPMorgan try to manipulate or try to affect the market and how we as individual investor to deal with those actions. This is Oracle business model. There are mainly two services and product Oracle offers. The first is the ERP. To understand what is ERP, just thinking about the company you work in. Usually they have different departments like finance department, the marketing department, human resource department, and usually they have different goal, different mindset, different way of work. The financial department care more about the return on the investment, while marketing care more about maintain a good relationship with clients. In the past years, we have heard many news that technology companies like Microsoft, Google, they have layoff, and usually those layoffs are driven by financial department to cut the cost. However, marketing department may think that those actions will hurt the company's image, and the human resources department will think that those actions are not good for the morale for the employee left. So ERP is such a system to help coordinate different departments. Another business segment Oracle has is the data management. In the slide, I just show you different process to manage the data. To understand that, I will give you an example. Think about when the government collect consensus data. First, they will collect data to ask people information about whether they are male or female, where they live. But after they collect the data, there will be some duplicated data, or some people may pass away or move to other country after the data is collected. So the next step is to clean the data to make the data better for use. And after that, the government can analyze data to see if there are any trends in the data. For example, they can say if there is a aging population or if there is a decreasing birth rate in the data. And after the analyze data, they will store and preserve the data to prevent them from being hacked or lost. And after that, the consensus department may share the data with other government department when they schedule other policy, tax policy, etc. So this is the data management. It is very important to under the company business model. And in the later of the analysis, you can see how such a business model lay out throughout the stock valuation. And next, I will talk about how to estimate Oracle growth in the future. If you have been watching my previous videos or read my analysis, you know that I believe that a company's growth is driven by two things. One is reinvestment rate, which means for profit a company made in a year or in a period, how many percent of those profits the company will put back into the business for future growth. Another is return on capital. Return on capital is for the money the company invested, how many profit, how many return they can generate. For example, if the company invested $100 million and they return $20 million, then the return on capital is 20 divided by 100 is 20%. Well, for the 20 millions profit, the company may use 10 millions for future project, or like NVIDIA or AMD, they may use 10 millions to design new chips. Then the 10 millions divided by 20 millions profit is the reinvestment rate. In this graph, you can see several items I listed. These are all reinvestment Oracle made. If you do not understand those terminologies, you can watch my previous AMD video. In that video, I have explained that and told you where to find those information on a financial statement. So here, first, we have the CapEx from cash flow statement. These are fixed asset, like the buildings the company purchased, the factories. And then we have the acquisition. Acquisition means one company acquired by another company. And then we have depreciation. Once company has some fixed asset, the fixed asset have limited life, and the company can claim the value decrease over time as depreciation. For example, if an equipment is worth $100 million and it is life, then the company can claim 100 million divided by 10 million depreciation every year. While the company do not receive real money from depreciation, it can reduce the tax when accountant records them as depreciation. And the NOWC are capital you need for daily operation. Next, we have research and development. This is one of the most important investment for technology company. For example, for Oracle, if they want to improve their technology, if NVIDIA want to design new chips, those are the expense. And when I add all of them, I got total reinvestment. So here, data are summarized about the Oracle reinvestment rate over years. You can see that the reinvestment is very volatile. It can as high as over 100% and also as low as lower than 20%. And in fact, this picture is a core, the essential for this analysis. I want you to remember this graph and we will come back. The next is return on capital is how much benefit, how much profit the company generate based on its investment. We can tell that although the return on capital is also changing over time, it's much more stable than the reinvestment rate. And here, when I compare the Oracle reinvestment rate and the Oracle revenue growth rate, I infer that the reinvestment rate is the major driver for the Oracle. Because as you can see, every time the Oracle have a high revenue growth, when the reinvestment rate is a lot. In contrast, for example, like 2003 to 2024, Oracle improved the return on capital for almost 100% from 22% to about 40%. However, the revenue growth rate is still mild due to the low reinvestment rate. So, valuing Oracle stocks is still to the job to estimate Oracle future reinvestment, how much money they will put back into the business every year. And if you check this item, you can find that the major driver for the reinvestment rate is acquisition, is when Oracle acquire other companies. If you see the table, you can tell that Oracle made significant giant acquisition in 2023 and 2017, also 2015. And if you compare the data, you can see that those data reflected on the revenue growth comparatively. And the next part, I will talk about the how to value acquisition. According to the data from McKinsey and Harvard Business School, over 50 to 70% acquisition end up losing money, which means that in the past decade, when one company acquire another company, there's a 50 to 70% the return they generate is lower than the money they spend. So it is very important to value acquisition when the company you value have or will have acquisition in the future. But when I check Oracle acquisition, I found a challenge because Oracle has acquired over 60 acquisitions in the past 20 years. However, Oracle did not disclose about 70 to 80% detail for most of them, which means that I don't know how much Oracle spent on those private companies. So in the second part, I will explain how to value private company even if you do not have public information. Different from public company, private company do not have an obligation to file their financial statement, which means you don't know how much money they will earn, how much revenue and profit they have. So how do you estimate their value? I use three examples to explain how to value private company. The first example is when you don't know the company's revenue or earning, but you can estimate. These are information I got from Oracle official website. In 2020, Oracle bought a company called Nor1. What Nor1 do is think about when you book some hotels online, you usually will see different price, right? They usually come with different discount or promotion. And Nor1 is such a technology company to give customers those promotion. And those hotels in return pay Nor1 a fees for those promotion. Well, I cannot find nor one's revenue and profit. I found hotel brands who are customers of nor one. You can tell that there are many names you are familiar with. We have Fairmont, Hilton, IHG, that is Holiday Inn. And I was thinking, if I can know how many hotels each brand have, and I can know how many rooms they have, then I can estimate Nor1's revenue. So first I got their hotels and I got how many rooms they have in millions. But another thing you need to be careful is you need to do some common sense check. Hotels are not going to sold out all of their rooms all the time. So I also checked the occupation rate. That means how many percent of rooms usually are sold for hotels, and that is about 66%. And the next, I need to know how much Nor1 charge those hotels, but I don't have the information. And that brings about another important mindset in valuation in investment. When you have something you don't know about the company, you should have a belief, you should have an mindset that it's unlikely that this is the only company in this field. It's very likely that there are many other companies that are similar to this company, right? So based on my research, I found that for this kind of platform, they charge hotel brands a fixed price per room per year, and that price ranges from 43 to 100. And then now I can estimate the revenue. For larger, more renowned hotel brands, I will assign them a lower price, while for some less known hotels, I will give them a higher price. So right now I have the hotels, I have total hotels of brands that work with Nor1. I also have their rooms. I multiply the occupation rate and I multiply the estimated price. I can know Nor1's annual revenues, and annual revenues is about 85 million. And after that, my work become easier. I can do the free cash flow model. If you don't know free cash flow model, I will explain in more detail later. But you can tell that here I estimate how much revenue the company made, and I multiply by the technology industry profit margin. I got the estimated profit, and I estimate the value today is about $400. Another thing is called illiquidity discount. When company want to acquire another public company, usually they need to pay more money because for public company they have a stock price. You can know their market capitalization. For example, if a company have 1 billion market capitalization right now and you want to buy it, usually you need to pay more than 1 billion. In contrast, for the private company, they usually have fewer buyers, so the buyers have a higher room to negotiate. And according to the data from New York University Business School, the illiquidity discount, according to Norwan's revenue, is about 27%, which means that because it is a private company, usually they will get paid about 27% less than what they should have paid. So I use this value multiplied by 1 minus 27%. I got the estimated value for Nor1 is about 280 millions. And this is just the data I got from the Statistica. Those are premium that the company pay when they have acquisition. For example, here we have that for the worldwide for 2018 is about 23.8%, which means that in 2008, usually when one company buy another company, they need to pay about 23% more than the market price. And here I just try how investment bankers price the company. If you recall the example I talked at the beginning about the second-hand ticket, when people try to resell the football or concert ticket, how do they determine how much they charge it? They will say how other people sell it, right? And that's exactly how investment bankers work. When they set a price, they do not do the free cash flow. They say how other similar companies are priced. For example, they probably will get about 50 or 100 similar companies, and they check their stock price, and they use that divided by their operating income, and they get a ratio. For example, here the ratio is about 31, and they will say if a company has a ratio lower than 31, that means the company is cheap. And if the company have a ratio higher than 31, that means the company is expensive. But you probably wonder, is that too arbitrage and too random? For companies that have the same price to operating income, maybe one company they have a giant debt, they have 1 billion debt, while the other only have 50 millions. One company is old company, it has been over 100 years old, it has fewer room to grow, while another company is a young company, it has a great future. If you think about that way, then graduation, you have the mindset of being an investor. And I agree with that. That is very true. But right now, I want to know how much money Oracle spent to buy those companies, rather than how much money the company worth. And when Oracle acquire a company, they are lured and advised by the investment bankers to buy the company. So when I want to estimate how much Oracle spent, I need to think in the eyes of traders, of investment bankers. So this is how I do it. I got EBIT, the operating income, and I multiply by the price to operating income ratio. The estimate is about 571. This is the first example to value private company. The second example is when you cannot even estimate the company value with revenue or earnings, but you have some other set information. This is another platform acquired by Oracle called DataFox. What this platform do is it just collect many business information data. So as the picture show, if you want to learn about the company, you search Uber, it will tell you the fund name, the description of the business, and other information like the major management team and the Google search volume. Well, I cannot find any revenue or profit information. I found on the Oracle website, it says that the data fox has 6.8 million business information in 2020, and they expect the company will grow 2.2 million for next 5 years. And now I got a way to estimate the company value and the price. I first found similar companies that are offering business information services like the DataFox. I got some big name you may heard of like PitchBook, SB Capital IQ. And then for those companies, some of them they have revenues, they have public information, right? For this company, I say how much business info they have, how many users they have, and I use the user divided by data. I got the user to business ratio. And then I use the median ratio multiply by data fox business data numbers, and then I multiply by those revenues, I can estimate data fox. You may find that this way is too random, and in fact, this is exactly how investment bank traders price company when they have few information. For many technical company or young company, it's very common for them to lose money when they just start funding, and some of them even do not have revenues. And for investment banker traders, if this company do not have profit yet, they probably use price over revenue ratio. And when the company do not have revenue, they use price over user data, etc. So I remember that when Zomato, the Indian food delivery company, went public, when investment bankers have few information, they use the user data. They say how many users the platform have, and they multiply by a ratio to say this is a value. And of course, that is not reflective and reasonable enough, right? Because many platforms they have many users, but the users does not necessarily transfer to values. But again, right now I want to know how much money the Oracle spent to acquire the company, and rather than how much the company worth. But later, when I got information, when I estimate how much Oracle spent on all those acquisitions, and I add other investment, and then I use the Oracle operating income, the profit divided by total reinvestment, I can solve the problem, right? Because those operating income are real number reported by the operating income. So for example, if the company is only worth $5 million, while investment banker advised Oracle to buy for $10 million, then you just lose 50%, right? Lose is lose, it's okay. And the third example is when you cannot even find any set information, when you cannot even estimate the revenues at all. Another way I do is I use the market share method. So this is another company called Telluride, acquired by Oracle. It is a telecom company using a technology called SD-WAN. If you are curious, you can read my previous analysis on my website in the info box. I will not spend too much time explaining technology because that just will make it too long. Well, the company is using the SD-WAN technology. So I first checked from the IHS market, that's just a public information, about the total market, how many market share the Tether have in the SD-WAN technology market. And we can tell that it has about 2.68%. I can also get information over the total expected SD-WAN market in the future. So I use the future total market multiplied by Telluride market share. I got the estimated price for Telluride at that moment. Well, you may think that the Telluride may have a bigger market share in the future, right? That is totally right. But right now, I want to know how much Oracle spent. I want to know how much money investment bankers think the company worth, and they will use the market shares when the deal happens. So these are three ways to value private companies. And after I got all those information, I just add up Oracle acquisition by year so that I can know how much money Oracle spend on acquisition annually. But another thing I want you to be careful is that company cannot grow forever, right? Especially when they count on acquisition. One typical example is Cisco. Cisco is one of the most successful company in the dot-com boom, and they really rely on the acquisition. If you see the picture, you can see that Cisco stock has been skyrocketed since dot-com boom from $20 to $80. But after that, they keep making acquisition as before, but their stock price has been decreased. And this graph, in fact, is very interesting. When many people buy stock, they said, I'm going to hold forever. The stock in the long run always increase. And if they see the picture, they will say, you see the Cisco, even if they decrease a lot from the high, after 24 years, they still recover. I disagree with that. I want to ask you, are you really willing to buy a company at 60 in 2000 and wait for 20 years to recover? I'm not. I believe that the long-term investment means that your investment is not affected by the short-term movement or volatility, but it doesn't mean that you just never sell. If a stock goes higher than my maximum estimation, I feel okay to sell and I can buy again if the stock decreases rather than hold it forever. And here I just use a function in Excel called scenario summary. I just say for Oracle, when they spend different acquisition investment in the future, how much value per share they will have. And here you can tell that I have 20-year, 10-year median, 10-year average. So for example, 20-year median is for the past 20 years, Oracle spent about $3,000 million a year on acquisition. So I just make it last about 6 years and I gradually decrease to zero. And the median price I got in my last valuation is 105. But when I review my valuation, I found that I need to make some adjustment. Here, this is a detailed Oracle free cash flow model. First, we have CapEx, is capital expenditure. I use the Oracle capital expenditure divided by its revenue, and for the past 10 years, I get the median. And then I just gradually decrease the capital expenditure to the industry average. I also do that for the R&D. And here we have acquisition. I just try different numbers here. And after that, we have NOWC. These are the total estimated reinvestment. And we got the reinvestment rate and return on capital. I got the growth rate. We got the revenue. And multiplied by the margin, multiplied by the tax, we get after tax operating income and we get the free cash flow. But when I did the process before, if you see the reinvestment rate, you see that it's kind of low, right? The reason for that is I do not include the CapEx in the reinvestment. Why? Because I realized that for a same dollar of investment in CapEx, it will generate a different return from those same $1 invested in R&D and acquisition. Just think about when Oracle spent $1 million to build some building versus it spent $1 million on things like research and development, on things like acquisition. The return on the technology research and development will be much higher than the return on the capex, right? So if I include all the capex reinvestment into the total reinvestment, I will exaggerate the company's growth in the future. So in the total reinvestment here, I do not include the capex, but in the free cash flow, I do subtract the capex because you also need to spend that, right? And if you compare my number before, I used to estimate about 105 because I use the current capex of revenue ratio forever. But for those fixed assets, like buildings or factories, the company is not going to keep that high capex ratio forever. Think about that. If Oracle have revenue 10 times, but it does not necessarily will have its building and factory 10 times. Just think about the money Microsoft made on the Microsoft 365. There are many people download it, right? If there are 1 million more people purchase the Microsoft 365, cost to produce the software is almost the same. So that's why here I gradually decrease the capex to the industry average. And another thing is in my last evaluation, I get kind of lazy. I just try all scenario like 10-year median, 10-year average, and 10-year and 20-year average. But we all know that the median is much more reasonable than the average. So in the next scenario, I only include the median and I estimate that the Oracle value at this moment is 161.72. And after I estimate the value per share, that's the price I will buy more at this moment. The next step is estimate the price the traders will set for the Oracle in the future to decide when to sell. But before I talk about that, I want to talk about something interesting. If you see my free cash flow, you found that I have an item called Microsoft effect on revenue, right? That's how much I estimate Oracle can make from Microsoft when Microsoft announced to have a partnership with Oracle. And if you want to know how I estimate that, you can check the link on for my post in the info box. And I just do not spend more time here. And there's something interesting. In 2023, Oracle stock decreased after the earning, and JPMorgan announced on the September 13 that the stock can go even lower. However, just one day after JPMorgan announcement, Microsoft and Oracle announced that they will have a partnership, and the Oracle stock also jumped back from their low after the earning report before that date. This is the challenge we individual investors face when we are boomed by news around us. Many people, when they buy stock, they like to see how those institutions say about it, how those investment banker analysts, CNBC talk about their opinions on KCOs, right? But are they really right? If you see the news, there are three possibilities, right? First is JP Morgan really believe that Oracle can decrease more. And if you believe them, you will lose money or you will miss opportunity because JP Morgan is wrong. The second possibility is JP Morgan, they know the Microsoft and Oracle will have partnership before the announcement, but they intentionally to give people misleading information to try to affect the price. And if you believe them, you will either sell too early or miss the opportunity. And of course, there are third possibility is JP Morgan sincerely think that the stock can go even lower, but they're also wrong. So as an individual investor, how do you deal with those news? I want to tell you that do not listen to them. Regardless of they are right or wrong, if you listen to them and you make decision based on them to buy or sell the stock, that is not your investment. And you hand over your freedom and your wealth to other people. So always try to make your own judgment when you decide on how to invest. And next, I will estimate how much the price the investment trader will push the company to decide when to sell the stocks. For investment bank traders, they use something called the P ratio. What they do is for a company, they will find many similar companies in a sector. They will use their stock price divided by earning per share, and they get a P ratio. And they will estimate the future earnings and then use the future earning multiply by the P ratio. That's the price target they set. And here, these are data from the New York University Business School. We have several ratios. Is the P ratio for the software system. The current PE is the P ratio for the system software industry right now. It's about 180. And the forward PE is the expected PE ratio in the future. It's about 51. And it's a PE for the past 12 months. It's about 200. If you see those ratio, you may think, oh, they are so different, right? They can lead to totally different price, right? And that's exactly how traders, how pricing works. Because they try to push the momentum when other people want to buy, or they try to hurt the momentum when very people want to sell. So the P ratio is always very volatile. So what I do is, if you recall here, I already estimate their revenue in the future so that I can estimate their operating income and their after-tax income in the future. With that, and I also subtract the interest rate divided by total shares, I can estimate the total earning per share for next 10 years. And I use that multiply with those P ratio. I can get all these possible price that investment bankers will set. And here we have so many data, so I just set a distribution. But another thing is very important in investment is the money today is worth more than the same amount of money in the future. Let's think about that. If I ask you, would you rather take $1 million right now or $1 million 10 years from now? You take the first option, right? Because if you take 1 million right now, you can make investment to make more money. And also, the value of $1 million after 10 years will be lower than today because of inflation. So what I do is I will say for those future price, how much they worth today. That's called discounting. For example, for next year, if this price is 568, I use 568 divided by 1 plus 10% because 10% is the average SP 500 return. That's tell me if I decided to buy Oracle rather than buy SP 100 index, how much after the opportunity cost, how much this 568 worth today. And I did all of them. The median is about 330 and the mean is about 400. But the median and average are middle point of the data, right? To decide when to sell the stock, of course, you want to sell it when it's overvalued. So I refine the data. I select all data that is higher than average and median. And the new data distribution is about 600. So now I can decide when to sell the stocks. I will sell about half of my shares between 300 to 400, and another quarter between 500 to 600, and another quarter between 600 to 700. And if you check my previous announcement, that's exactly how I make the decision. So this is my Oracle valuation. And by the way, I bought the stock at $56.98 in 2020. So this is my Oracle stock valuation. Feel free to ask a question in the comment and I will answer them. Thank you.